focus of this webinar is really going to be on debt and minority recapitalizations, not majority, but really the range of financing options and structures within those two buckets, both traditional, but we're focusing here on alternative lending sources. John, will you go ahead and describe the different types of lending and investment buckets that companies may end up running into in a bit more detail?
Sure. So typically in a healthy environment, a bank will provide traditional senior debt, working capital backed by receivables, and inventory term loans backed by machinery and equipment and other hard assets. And then maybe a mezzanine player will come in behind them. In today's environment, the Business Development Corporation or the alternative lenders are going to want that first senior secured position. So they will provide what's called a unitranche facility, where they will provide both the senior and the junior capital in one fell swoop. So they have absolutely control over the situation. Mezzanine debt can still play a role, either in conjunction with the existing senior lender. Let's say a bank, is not necessarily asking their client to leave, but they cannot provide any additional capital based on the situation they're in. So mezzanine debt would come in and provide additional capital on top of the bank or the senior capital to help the company through the current liquidity crisis. And then a big change in the last month, based on conversations we've had with private equity groups, they have kind of conceded to the current environment and are actively looking to take minority positions in companies. So they don't get control like they so often want, but they get to know a company, and they provide instant liquidity to help a company through the crisis. They work together to devise a short-term plan, but also a long-term plan. And if a private equity firm can see the way to long-term value maximization over the course of the next 3 to 5 years, then they're telling us they're going to take a really hard look at investing in minority equity and even debt and equity, which kind of falls under the parlance of structured equity, where they would invest both debt and equity into a situation and not have control. So that's a big shift. It started over the last couple of years just because the private equity world has become so competitive. But I would say, Ashley and I have probably received 10 or 20 emails in the last couple of weeks saying we are aggressively looking to take minority stakes in businesses and help them grow their way out of this unfortunate situation and help them really take off and get to the next level when this is all over. So a variety of different situations are available to meet liquidity needs today. And then obviously, in some cases, it'll be obvious when there's a need for alternative financing. If you're running out of liquidity and you're just facing pressure from your existing lender, your bank, and you have to refinance, or else, there are special situation distress lenders that are looking for those situations and can help provide liquidity in a very fast time period to take out a bank, take out another senior lender, and step in, provide a unitranche facility, and help the company survive and move forward. Another situation is if your company was in a sale process and either it's stalled or it's been canceled, but the shareholders still desire liquidity, then the lenders and or equity funds are aggressively looking for those situations as well. They know there's going to be a lot of such situations, and they think they can create healthy situations that appease the shareholders' need for instant liquidity, but they still maintain control of the business, and they devise a plan to move forward and help grow the business. And then on the other side of the coin, there are going to be buy side opportunities for sure. Valuations we're already starting to creep down from let's say the heyday of a year ago, and now they're obviously going to come down substantially. So we anticipate there will be a lot of acquisition opportunities in the next 3 to 9 months, and capital providers are certainly willing to step up and back those companies that are looking to find capital to help take advantage of those acquisition opportunities.
And depending on the financing or on the needs and goals of the business owners that John just kind of highlighted there for you, there's numerous benefits to pursuing alternative financing. These types of funds really can provide flexibility in principal payback, covenants, and equity dilution. And what we've been seeing is speed and certainty to close has generally been the key focus for most companies during this time, and several of these funds have the flexibility to accomplish this depending on industry focus and really level of comfort in these opportunities. One point that many companies don't really consider is, unlike a traditional bank, alternative financing investors really can bring a much broader network and resources than just dollars. This could include industry players or other C-suite members in their fund of the companies that they are working with.
So a couple of examples there, just to kind of amplify Ashley's comments. One, we just learned of a situation where a family office was intimately familiar with an industry and was able to close a financing 1 week after the LOI was signed. That's obviously extremely fast, but the situation dictated speed and certainty of close, and this family office delivered. Another situation is we've heard of a stalled financing for a healthy business that won't necessarily suffer from the crisis a whole lot. They had acquisitions lined up and had received the term sheet from a lender. To no fault of their own, the lender pulled the term sheet because of issues in their own portfolio, and a private equity firm stepped in. They knew the industry well, good relationship between the two parties, and they signed a term sheet with the company in the course of a week. And they also brought a debt partner along. So now that business is on track to close those acquisitions and has excess capital in their back pocket to do deals. And then one other situation, which I'll let Ashley talk more about, because she worked on that situation, is that we have a retail client in the wireless space that has grown exponentially with funds that they received from a lender. So Ashley, you want to talk about that a little bit?
Yeah, sure. So the client that we had worked with has grown from about 15 doors, is how the retail space looks, to 250 doors today. And we brought in an alternative financing lender to come in and help them. And really what that helped the company connect to was a network of other CEOs and other executives that this alternative financing partner was able to provide, that a normal traditional bank just would not have the access to really open their doors and help them promote different growth for the company, but also any challenges that they have. They were able to talk with this alternative investor, and the investor was able to connect them with different CEOs and C-suite members that had gone through similar things. So it was a really great pairing and an unforeseen kind of benefit that the company really benefited from and has really helped propel their growth.
Excellent. So again, over the course of the last couple of years, and certainly the last month, these investors have been pushing their ability to do a lot more than just provide capital. And there's a few examples of just such cases. So moving forward, some of the key deal considerations that will be in term sheets that the companies will receive from lenders and investors. PIK interest is payment in kind. That's a very key feature today. It's essentially your interest accrues, and there is no cash pay. That can be for as little as 3 to 6 months. I've seen it go as long as a year. In this environment, lenders are trying to structure deals that will not obviously swamp a company to the point where it has to liquidate, and these alternative lenders can provide some flexibility in that area. Another key area is preferred equity is extremely common and will be a common feature in deals that involve equity. Preferred equity sits between the common equity and the debt. Often involves a dividend and can be participating preferred, so they also participate in the upside of the company's growth, the common equity. And then finally, down towards the bottom of the slide, there are, in terms of covenants, maturity and liquidity rights, lenders are trying to delay the cash components of deals to provide excess cash for companies as they sift their way through the crisis. And obviously that's going to be reflected in the pricing because of the extra risk that's being taken on early in deals by these lenders. But the flexibility of those structures is key to so many companies, and these alternative lenders and family offices are willing to discuss those features as we navigate through the crisis.
And the lenders and investors are looking at a variety of criteria when trying to determine how to best position those deal considerations that John just covered. And really, in the current environment, they're focused on pre-crisis operational performance. So how you operated before. This is definitely something that they're going to look into, the performance through COVID, but it's definitely focused on the back end pre-crisis. Also the company size and what the impact of debt would be on a debt to EBITDA multiple level, how the industry is currently performing through this, as well as how it might perform through post the virus. And for companies with more complicated cash cycles and short-term liquidity challenges because of this virus, a 13-week cash flow analysis may be performed to really understand working capital and how much cash is required on a go-forward rolling basis.
Yes, and I would just add, Ashley, that the conversations I've had with lenders, they're going to look for situations where revenue is hopefully just being deferred and not eliminated, and what is the plan for the company to recover that revenue. Hopefully companies are in contact with their customers and managing those relationships, and their supply chain as well. So when the crisis lifts, there's a plan in place to rehire employees if they've had to furlough employees, and understand exactly what their customers' needs are, how that supply chain can deliver materials and products, and so the company can hit the ground running once orders pick back up. And then finally, looking out longer term, investors are going to want to know, how have companies assessed the impact of this crisis on their business, and what repairs, improvements can be made to make the company even better, and what opportunities can be chased to potentially provide growth and get a leg up on the competition as everybody kind of finds their way through this mess and comes out the other side looking to build and grow their businesses as we head into 2021.
So we're just going to run through just two case studies here just to give an example of where alternative financing could really be beneficial.
Right. So in this first situation, there's two owners of a $50 million revenue business that's doing $9 million in EBITDA. Steve and Dave, they've got acquisition. Their business is healthy, not tremendously impacted by COVID. They needed $25 million for two acquisitions. They had a letter of intent, or I had a the acquisitions are under letter of intent. They had a term sheet for $30 million set to go, and that was pulled due to the crisis. Company performance remains stable, but Steve and Dave these acquisitions were in the works for quite a long time, and there's a bit of deal fatigue setting in. So were concerned that these acquisitions might go away, and they're really critical to the growth of the business. So speed and certainty to close are critical factors for them. The owners, they're really looking to maximize long-term value, see this COVID-19 actually as a potential opportunity for them, and didn't want to miss it. So they entered into discussions with an equity partner and a debt provider who are really dug into their near-term and medium-term plans for integration, really understood how these acquisitions would fit in and what the risks of the acquisitions were relative to COVID-19. And then they were comforted by the fact that they have a deep management team with a broad range of experience. I think they've been, the key executives have been in the business for 20, 25 years. So they were able to secure a $50 million participating preferred equity piece and a $20 million term note to both fund the deal. And I'll let Ash to the impact of the structure.
Yeah, so pre-financing, we had a split of equity with Steve owning the majority at about 70% and Dave owning 30%. No debt on the business pre-financing, which really put them in a good position to find a good partner to get the acquisition financing that they need, as well as you can see here, after running a focused and efficient outreach process, given the timelines and time constraints they were working on with the acquisitions, they were able to, as John had mentioned, find an equity partner to provide a $15 million participated preferred piece with an 8% dividend, as well as a $20 million term loan. And what this helped is it both met the needs of the $25 million in acquisition financing for those acquisitions that were under LOI, as well as provide another $10 million for liquidity and future acquisitions if they needed any additional liquidity to get through the crisis. Even though their performance was relatively stable, they had that flexibility. And then if another acquisition another potential acquisition came up, they had some financing available that they could lend or draw on in order to get those acquisitions done quickly. So this was more of a rosy scenario. We have our second case is a little bit of a less rosy situation. So we have an owner, Bill, who owns 100% of a manufacturing business, 70 million in revenue, 20% EBITDA margins with some collateral. The crisis happened, they defaulted on a covenant and started to receive some pressure from their current lender to leave. Partially, this was due to the lender had grown over the years since the original loans had been committed, and the company had just fallen on the smaller side for this lender, and they were pressuring them to kind of get out. And then due to the crisis, there was some impact on financial performance, and so the company really needed flexible deal terms. Bill had some hardline requirements as well, as he preferred no personal guarantees and no equity dilution, which really made him a good option for alternative financing. John, do you want to talk a little bit about what we were able to, or what he can do here?
Sure. So Bill again was seeking a quick remedy, as we've discussed, there are many lenders, alternative lenders out there looking for just these situations where the facility in place is under pressure, in large part only because of the crisis. And so the lender saw that the company had operated successfully pre-crisis, and the company was able to put forward a plan that showed how they could operate during and after the crisis and be successful. So the lender stepped up and provided a $30 million unitranche loan. It provided significantly more capacity and flexibility than their existing facility. Pricing is significantly higher, but they were able to structure a payment system, a payment structure that conserved cash and provided ample funds for the company to make it through the crisis and come out on the other end in a position to take advantage of both their existing operations and other opportunities as the competition may have challenges of their own. So in the end, Bill was able to maintain 100% equity of the company, didn't have any dilution, and was able to generate some additional cash to provide him comfort that his company was not only going to survive, but hopefully prosper as the crisis eases.
Now that we've walked through a couple of case studies, I think it's important to dive into a little bit more detail about the deal process itself and what we can do to prepare. So the first step in preparation is really understanding the key objectives and priorities for the owners and the company. And really what this helps do is understand the best asks and which investors and lenders should be focused and targeted to present that ask. So understanding that during preparing for the deal process, you may have a limited time to get ready. So as much information as you can collect, the better. We list a couple here, but I think best practice from our side is really to dedicate an internal resource to handle the collection of information and act as a point person within the organization. It helps the whole process go by a lot more efficiently.
So now that we've kind of covered, the landscape in terms of what type of capital is out there, what are some of the key features, a couple of case studies describing situations that may exist today, and kind of how to prepare. We've reached the point where you're in a position to select a lender or a partner to move forward with. And I can say the key criteria on the left there, the certainty of close and speed to close, may not have been the boxes that we listed there as soon as 3 months ago. But the environment has changed, and obviously a lot of our clients and potential prospects are going to be in a situation where they want to know with no uncertain terms that a lender is going to step up and close the deal. And we actually spoke with a lender last week who was mentioning to us how several lenders made their name in 2008 by stepping up and doing what they said they were going to do, i.e. Closing deals in an expeditious manner and saving companies. So it's an interesting time for lenders, many of whom are under pressure for different reasons, but those who come through are certainly going to build bonding relationships with clients as they step in and help companies through the terrible. So in addition to certainty of close and speed, you want to consider non-financial considerations as well, kind of as we were speaking to earlier. What is a investor or lender's network? What is their experience? Are you comfortable with their culture? And you can get some of that information by speaking to references. Most lenders and investors will let you speak to CEOs who they know and speak to their track record. So there's a lot that goes into it, but certainly the left side of this page has stepped up in importance in the last month. And then, so you're choosing a lender, or that's part of the process. How long does it take? As I mentioned earlier, it could, some processes need to get resolved in a hurry today. And as I mentioned with the family office business, the family office that stepped in and closed the deal 1 week from LOI, they can be done in as fast as a month. That would be extremely quick and would probably not lead to the best resolution for the customer, other than that they're still around. Ideally, it would take at least 3 months to make sure you find the right partner with the best terms and put a competitive process in place to generate the best outcome for both sides, really. The lender and investor, they need to get to know you too. And it's tough to do that when you're just pouring through documents to try and keep a company alive.
Yeah, when we think about a deal process, we really bucket it into 3 phases. So the first phase I talked briefly on earlier on preparing, and what we're doing in that phase is helping the business owners and identify the needs and requirements that they're looking for, and that really helps us develop an extensive and a strong lender or investor list. So through that phase 1 process, we're collecting information from the company and preparing our go-to-market materials. That's, those materials include a teaser, which is a redacted, 1 to 2 page document that we try to drum up interest with. It's a confidential information memorandum, which will cover the company information as well as details about the requests. And then after those materials are completed and our lender and investor list has been vetted with the company, we start reaching out and sharing information and generating interest for these lenders. The end of this process is really, or the end of the phase 1 process is really when we receive the initial term sheets. We move on to the second phase where we're selecting just a group of those initial term sheet submitters to move on to the next round. And that's when we're doing management presentations with the investor and lender teams. And the management presentation is where you start to pick up on those non-financial aspects that John mentioned on the prior slide, the personal fit. So it's a time where the company is able to assess the potential investor or lender, and the lender and investors can assess the company and management team in more detail in a face-to-face or potentially in this environment a virtual level. So after those meetings, we work with the business to select the best fit, and it's deal terms, it's personal fit, it's the resources and track record. We help the company choose their best fit and then move on to the final phase, which is mainly due diligence, documentation, and closing. So once the documentation and due diligence has been completed, the term sheet's finalized, the deal closes, and then the relationship begins with the investor, the company, and the potential investor or lender.